Okay, so our third method of depreciation is the double declining balance method. So it's the one that's a little bit trickier. The first two are a little bit easier to deal with. So double declining balance method, it's a faster rate of accelerating depreciation. So what we're doing here is we're recognizing more depreciation expense early on in the first few years that we own it. And we may do that to expense it out, have higher expense in the first few years, because we know with most, equipment, especially or trucks, vehicles, that sort of thing, they work better the first few years, right? They're newer, they work better. So there's not going to be very much maintenance expense or repair expense. So sometimes we use double declining balance method. So we expense out more of the cost early on when we have less maintenance and repair expense. So that way, in the later years, when maybe it's older, it needs more repairs and maintenance, we've kind of freed up expense, to cover that, okay? So we're basically just costing it out a little faster. So it has 3 steps. This one gets a little tricky, okay? So double declining method, balance method. Step 1, we determine the straight line percentage using the expected useful life. So double declining, we figure straight line percentage. That's actually super easy. We looked at that in another slide. We always take 100% divided by the useful life in years. So straight line percentage is always 100% divided by the useful life in years. Like in the first straight line example, it was 5 years, so the straight line percent is 20%. If it's 10 years, it's 10%. So 100% divided by useful life in years. That's pretty simple. Step 2, we determine the double declining balance rate by multiplying the straight line rate by 2. So we take, on part 2, we take the straight line rate multiplied by 2 equals, I'm going to put double declining balance, DDB for short, equals the double declining balance rate. So again, in step 1, if we had got 20%, step 2, we would take 20% times 2. Our double declining balance rate would be 40%. Okay, so those 2 steps are pretty simple. Step 3, we're going to calculate our depreciation expense by taking the book value of the asset times that double declining balance rate. So depreciation expense equals book value times the double declining balance rate. What's my book value again? What's the formula for that?
Cost minus accumulated depreciation.
Very good, yeah. Book value is cost minus accumulated depreciation. So this one's different, right? In the others, it was always your depreciable cost. Notice we don't deal with the salvage value in these formulas. Double declining balance does not consider the salvage value in the formula. That creates some issues for us. So double declining balance is kind of a trickier one. The first 2 steps are easy. Step 3, we just always have to remember it's the book value times the double declining balance rate. So in the first year, our book value is just the cost. In year 1, it's just cost times the double declining balance rate. But in year 2, we would take cost minus accumulated depreciation to get a book value and multiply that by 40% or whatever our double declining balance rate is.
So residual value has nothing to do with this?
It only does at the end. So that's where double declining balance gets a little tricky. When we're calculating yearly depreciation, there's no salvage value in all of this. So what happens is we have to consider, in like usually in like the last year or two, we can't depreciate more than the depreciable cost. So since this formula is not considering the salvage value at all, at the end of the depreciation schedule, we have to make sure that we're not depreciating more than the depreciable cost. So we actually look at it more in like the last year or two and make sure that we're not going beyond that. Usually the last year. Okay, but let's calculate one first before we get into all the, So using the same example, the forklift owes $24,000. Expected useful life is 5 years. Residual value is $2,000. So again, we know our depreciable cost is $22,000. Over 5 years, we cannot depreciate this forklift more than $22,000. That's what that means. At the end of 5 years, it should have a book value of $2,000. For the first year, we calculate the straight line percentage. So we take useful, or 100% divided by the useful life of 5 years. So our straight line rate, percentage rate, is 20%. Step 2, we double that. So our double declining balance rate is now 40%. So we're going to depreciate this asset at double the straight line. So 40% a year, right? A rapid depreciation. So in year 1, again, our book value is just our cost. It hasn't been depreciated at all. So in year 1, we take cost of $24,000 times 40%. So our year 1 depreciation is $9,600. Okay, $9,600. So if you remember when we did straight line, it was like $4,400 in the first year. You can see it's actually more than double the straight line amount because the straight line method considered the salvage value. Okay. Double declining balance, first year, $9,600. Same debit and credit, debit depreciation expense, credit accumulated depreciation. So to kind of go over what I talked about, that salvage value, this is the depreciation schedule for this asset. Again, the first year, there was no accumulated depreciation, so our book value is the cost, and we came up with $9,600 for our depreciation. After we did that adjusting entry, we figured out our new book value. Book value is cost of $24,000 minus the depreciation of $9,600. So at the end of year 1, the book value of the forklift is $14,400. We carry that down to year 2. The book value is now $14,400 times 40%. Year 2 depreciation is $5,760. We then take $14,400 minus $5,760. New book value is $8,640. Okay. So when we move into year 3, they're also showing us we can take the full cost minus the total accumulated depreciation for 2 years. Okay, it's the same calculation. Book value is $8,640 times 40%. The book value minus the new depreciation is now $5,184. So we're nowhere near that $2,000 salvage value. So we keep going. Year 4, same thing. At the end of year 4, though, our book value is $3,110.40. We know at that point, when we depreciate in year 5, at the end of year 5, our book value has to equal salvage value. At the end of year 5, this book value needs to equal the salvage value of $2,000. So in year 5, we know we can only depreciate the difference between these two. Okay, so in year 5, we take the book value minus the salvage value, basically, and we know our depreciation for year 5 is $1,110.40. Okay. So at the end of the useful life of this asset, the book value should always equal the salvage value. So that's the tricky part of double declining balance. So again, all we have to do is at the, going into the next year, we just want to depreciate to get down to salvage value. So salvage value minus book value, or sorry, the book value minus salvage value. will give you your depreciation expense for the last year. It's just for fun. I think it does it, but I'll just do it real quick. If we had actually depreciated it based on the 40,000, we'd take $3,110.40 times 40%. It would have been $1,244.16. Well, then our asset would be worth less than the salvage value. Okay. So in that last year, we can't just multiply by the double declining balance rate. Now, why wouldn't they just consider the salvage value and fix that problem? I don't know. If I were coming up with the method, we would have, right? Then we wouldn't run into this problem. But again, if we did consider the salvage value, our book value, you know, our depreciation would be less. So they're trying to depreciate at an accelerated rate. Any questions on that one? That one's the tricky one. And it's really fine if you're only doing the first year or two. It's when you move into the later years where it kind of gets confusing. All right. Yeah, I knew it. I knew I should trust my instinct. It tells me exactly what I just said. So here it's showing me the depreciation, you know, in graphical representation. So again, with our depreciation using double declining, we expense a majority, 40% in this case, up front the first year. So our depreciation expense gets much lower every year. And our book value drops more rapidly at the beginning and then kind of tapers off. But it doesn't matter which method we use. At the end of the useful life, the book value always should equal salvage value. This is if we keep this asset for exactly 5 years. Okay. So this is a good slide. You know, it goes over all 3 methods, gives you the depreciable cost, the depreciation rate, and you know how the depreciation expense is changing. This is just showing you all 5 years how the depreciation expense changes. So again, over 5 years, the total depreciation is the same, 22,000. But the amounts under each different method change. That's just a summary slide. Let's stop right there on the PowerPoint and we'll do the second example together and we'll probably stop for the day. I don't want to get into partial year depreciation today, so we'll stop right there. Go back to your practice and we can do the second one. So let's practice comparing straight line to double declining balance. So in this case, since we have a tractor acquired on January 8th at a cost of $85,000, has an estimated useful life of 10 years. We are going to assume it has no residual value. Well, that makes life really easy. When there's no residual value, double declining balance method, it's a lot easier. We just know we can't depreciate it beyond 0. So it kind of changes things a little bit. But we're just going to do the first 2 years for this tractor and look at straight line and double declining balance. So it says determine the depreciation for each of the first 2 years by the straight line method. Well, if I'm using straight line, what's my formula to calculate straight line depreciation?
Well, you have no residual. So just initial cost over useful life.
Very good. In this case, we have no residual value. So yeah, it's normally cost minus residual value over useful life. Well, there's no residual value. So here we can surely just take the cost of $85,000 and divide it by the useful life of 10 years. That one's really easy, isn't it? When there's no residual value, life is easy. So what's my depreciation?
8,500.
How much?
8,500.
8,500. Yeah, sorry, I thought you said 2,500. Sometimes I hear things incorrectly. Yeah, 8,500 per year. Well, under straight line method, what will it be for the second year? Yeah, same thing. So for my depreciation using straight line, it's 8,500 for the first year and 8,500 for the second year. And it would be the same for years 3 through 10 as well, 8,500. Okay. A debit to depreciation expense and a credit to accumulated depreciation. Well, then it says it wants us to use the double declining balance method. Okay. Well, when we use the double declining balance method, the first thing we want to do is calculate our straight line percentage. Well, how do I do that?
100% divided by the years.
Very good. 100% divided by the useful life in years, which is 10. So what's my straight line percentage? 10%. So straight line percent is 10%. What's my second step?
Multiply it by 2.
Yeah, and just multiply it by 2. Good. So to get my DDB rate, I take that 10% times 2. So my depreciation rate will be 20%. So how do I calculate my first year of depreciation?
Book value.
Yeah, very good. I would take book value, which in this case is my cost. First year it's always the cost, 85,000 times the 20%. Very good, 17,000. So under double declining balance method, my first year of depreciation is 17,000. What about my second year?
You subtract 17 from 85.
Very good. I need to calculate my book value, right? So book value, I'm going to take 85,000 cost minus 17,000 depreciation. What's my book value? 68,000. Very good. And then I multiply that by 20%. Very good. My second year depreciation is 13,600. So again, with double declining balance, the first year we can take cost by our rate. The second and subsequent years, we take our book value. So our cost minus accumulated depreciation was 68,000 times the 20% rate. 13,600. So with double declining balance, again, the salvage value, it doesn't matter if there was no salvage or there is a salvage. It's the same formula. But when we do straight line or units of activity, we have to consider the salvage. Any questions? Alrighty. Okay.